You're welcome to my channel. In this session, we want to look at audit risk. We've had a lot of unfortunate incidents of auditors being sued, being fined, being penalized by regulatory bodies because of negligence, because of oversight, or basically things that are supposed to be done were not done, maybe not following auditing standards and the rest. So audit risk happen a lot of time in the auditing profession. What's audit risk? Audit risk refers to the risk that an auditor may issue an unqualified audit report due to the auditor's failure to detect material misstatement, either due to fraud, to error or fraud. So you have a situation whereby the auditor is giving a clean audit report, whereas there are irregularities in that particular audit environment. So perhaps you are doing an application audit, a network audit, database audit, or even a financial audit. So things that are supposed to be detected were not detected, and which may lead to embarrassment or reputational damage or even litigation for the auditor. So when we're talking about audit risk, there are three elements of audit risk. You have inherent risk, you have control risk, you have a detection risk. So inherent risk is the risk that is due to the nature of the information asset or the auditee entity. Okay, so for example, in banking, the inherent risk is what? Fraud. There will always be attempts to commit fraud in the banking industry anywhere in the world. In the oil and gas industry, the inherent risk is accidents. Okay, there is always a lot of propensity for accidents, for explosions. Okay, in the oil and gas because of the nature of that industry. Okay, construction accident is also inherent with that particular industry. So we need to be able to understand that industry, the peculiarity of the business, the peculiarity of the information asset for us to be able to understand the inherent risk. So understanding inherent risk is knowledge driven. So if you don't know, understand, you don't have enough information, you cannot identify or document the inherent risk in the auditee environment. Okay, so the client management has a responsibility to identify, document, and manage their inherent risk, even though the auditors too must understand the inherent risk for you to be able to carry out a successful audit. Okay, you have also control risk as another element, okay, of audit risk. So control risk is the risk that controls put in place might fail. Okay, so you have a security guard page, and the day the robbers came or the burglars came, the security guard has slept. Okay, so that's a control risk. Your control failed. Okay, or you have a login mechanism put in place for the application, but somehow some transactions were not logged for one reason or the other. Maybe there was a bug on the application. So that is a control risk. So as auditors, you need to understand the inherent risk of the organization first before you now start evaluating the controls put in place by that organization, whether the controls are adequate or not. For example, we said the banking industry, they have the risk of fraud. So they need to put some controls in place like segregation of duty, standards implementation like ISO 27001 for information security management system, ISO 20000 for IT service management, PCI DSS, payment card industry data security standard like IT. So implementation of those standards help them to address the inherent risk in their sector. Oil and gas, okay, they have inherent risk of accident, explosions. So how do they respond? HSE, Health Safety and Environment. So they follow the HSE standards, HSE codes. The same thing with construction industry. Okay, so they have the same inherent risk of accident and explosions. They also respond with health safety and environment. Okay, strict implementation of HSE standards. So as auditors, you need to be able to, once you understand the inherent risk environment, you need to now look at the controls they put in place, whether it's adequate or not, and the likelihood of those controls to fail. Okay, then The last element of a audit risk is a detection risk. So that is the risk that the auditor is going to choose an inappropriate method, inappropriate testing, all right, or use a wrong sample, or interpret test result wrongly and arrive at an invalid or wrong conclusion. So detection risk is the risk uh, that is controllable directly by the auditors. The first two, the inherent risk and control risk, are direct responsibility of the management. But if the auditor is not aware of those two risks, then detection risk is going to be very high. So you choose a wrong sample, that's what we call sampling risk. Sampling risk is going to lead to detection risk because you are performing your audit test, audit procedures on a wrong sample. All right, you have the right test result, maybe accounting ratios, all right, and you don't know how to interpret them, so you can give a wrong interpretation to your liquidity ratio, investment ratios, and the rest. So your audit report is going to be invalid. Okay, I also want to add as we round up that first-time audits has a lot of propensity for detection risk because basically because you are new in the environment. So because you are new in the environment, a lot of things are still strange to you. So a lot of things you are supposed to document, query, you are not even aware they are there. So first-time auditors need to be extra careful. In my next audit, in my next video, we'll be talking about how to manage audit risk. So don't forget, audit risk is basically, auditors arriving at a wrong conclusion for one or two or many other reasons. And we've said that the elements or components of audit risk, they are inherent risk, control risk, and detection risk.